Income tax 2020. Itemized deductions, interest you paid. Come in, relax with income tax 2020. Itemized deductions, interest you paid. When thinking about the income tax equation, we're going to be down here in the below the line deductions in the itemized deductions, remembering that we can think about our income tax equation as basically having two halves, the first half being a modified income statement, second half being the calculation of the tax application then of payments and credits to get down to the bottom line, that being the tax refund or the amount due. We're going to be focusing here on the top half, that being the modified income statement. We're looking at types of deductions, which we can break out into two categories, the above the line, the below the line. The above the line being the adjustments to income, which could have different names to them. We're going to call them above the line deductions here to contrast them to below the line deductions, which will be either the greater of the standard deduction or itemized deductions. We're focusing in on the itemized deductions and specifically on the interest for them, noting that the itemized deductions would have to be greater than the standard deductions in order to have a benefit from them, the standard deductions being dependent on filing status, such as single, married, filing joint, and so on and so forth. So we're going to be looking at this line number 12. I know this 1040 is a little bit small, but we want to show the full 1040 here in a future presentation. We'll take a look at the 1040 in more detail in practice software and zoom into the components of it. Line 12 has the standard deduction or itemized deduction. We're going to take the greater of the two. And the standard deduction thresholds per filing status are on the left, so you have that reference when you're actually looking at the tax form. Now this is going to be the Schedule A. We're zooming into the component of the Schedule A related to the interest you paid. Now when thinking about the interest that's being paid, the primary thing that we're considering here is going to be the interest on like a home loan. So when people purchase a home, they will typically have a loan, a mortgage on it, and the interest on that loan will typically be here, or will go here, and it will also be one of the driving factors usually to whether or not someone will itemize and be able to take the itemized deductions or benefit from taking the itemized deductions. In other words, when looking at whether someone will itemize or not, whether they're going to use Schedule A or not, you're going to look at the prior year, see if they itemized last year, and then as you go forward, if you did the return last year and they did not itemize, oftentimes the thing that's going to push people over that threshold would be when they purchase a home and then are having the interest on the home loan. They took out a loan in order to finance the purchase of the home. That could be deductible, or part of that could be deductible, as well as property taxes on the home. And that's when you want to make sure that when that happens, that you're saying, okay, is this something that I should be including? And will they be itemizing this year, even if they did not itemize in the prior year? The thing that will trigger that, one, you'll have a questionnaire. They'll probably tell you if they purchased a home. And two, you'll probably get a Form 1098 that will tell you the interest that will be there. So you'll have documentation for it from the bank that has the loan associated to it. Once that happens, then you also want to be asking about the property taxes if it's not also on the 1098, which it may be. Now note that this one is a little bit unusual because the home loan, if it's a personal home, obviously, usually the interest for like loans is not something that would be deductible. So you don't have credit card interest, can't be deducted at one time in the past. You could deduct interest for other things that were not business related. But now really you don't deduct interest normally related to personal things. The home loan is kind of the exception that is still there. So then we could have interest for other types of items, including investment interest, which we can see on line 9. But again, of course, this one is the driving factor that we're most concerned about because one, it's the biggest factor, at least in the interest category and probably in all categories. And two, it's the one that often pushes people over to the point of itemizing. So that's where your main focus will be. Now note, although the 2020 Schedule A is out, the instructions for 2020 are not out yet. So the information below it, we're going to get into more detail. We've started out with the 2019 information, a lot of it coming from the 2019 instructions, and then made adjustments to it where applicable. But if you have questions, of course, you want to take a look at, and you're going into the tax season here, and you have questions about some area that is in a gray area for you or something like that, you want to go to the IRS website and take a look at the instructions first for the 2020 and then start your research there and go forward from there. We might include links to that once they are available, but of course you can find them on the IRS website at irs.gov, irs.gov. So interest you paid. The rules for deducting interest vary depending on whether the loan proceeds are used for business, personal, or investment activities. So that's going to be the general rule. Now note, if something is used for business, meaning you took out a loan for business, then you would think it would be deductible because it's a normal business expense, but it would be on the Schedule A. I mean, it would be on the Schedule C if you had a sole proprietorship or some other business return, rather than on the Schedule A. And that's kind of like the normal process. Personal interest is normally not deductible because it's for personal use. You don't get to deduct expenses for personal things, like you don't deduct vacation or anything like that. So normally you would think personal items not deductible. However, the home is generally the exception. And then investment, you could think of it as kind of like a business type of activity, which is why you might think that it might be deductible. So if you basically had interest on a loan that you used as part of an investment, then that expense that you had was in the process of helping to generate revenue, which is usually when something is deductible, because that's kind of like a business activity. So see publication 535 for more information about deducting business interest expenses. See publication 550 for more information about deducting investment interest expenses. You can't deduct personal interest. However, you can deduct qualified home mortgage interest. So that's going to be the general rule, meaning you can deduct business expenses usually, and interest expense would be a business expense, but it wouldn't be on a Schedule A, but rather on some other schedule, such as a Schedule C. Investment expenses you may be able to deduct because they're kind of like business expenses. You needed them possibly to help generate revenue. Personal interest expenses, like on your personal credit card or something like that, typically cannot be deducted because they're personal, the home being then the exception. If you use the proceeds of a loan for more than one purpose, for example, personal and business, you must allocate the interest on the loan to each use. So this is something you want to be careful of because it can get kind of confusing. So if you take out one loan and now you're paying interest on that loan, but you use the proceeds for that loan for multiple different things, then you're going to have to divvy up the interest to see whether it will be deductible or not, and prorate the interest in some way. So it would be best to take out a different loan for different purposes so you know where to deduct the interest if possible, but there might be other reasons for any case. You allocate interest on a loan in the same way as the loan is allocated. You do this by tracing disbursements of the date proceeds to specific uses. For more information on allocation, you can see publication 535. So if you need to allocate the interest on a particular loan that's going for different things that may or may not be deductible or may be deductible in different places, then you could go there and see how you might break that out. Obviously, usually, if someone has like a home loan, then if they got it when they purchased the home, then the whole home loan would be part of the purchasing process and you wouldn't be in that situation typically. So in general, if you paid interest in 2020 that applies to any period after 2020, you can deduct only amounts that apply for 2020. So use Schedule A to deduct qualified home mortgage interest and investment interest. So home mortgage interest and investment interest, those are the two interest formats we might be able to deduct then on Schedule A. The business-related items, typically if the business was a Schedule C business, would be there, or if it was some other business, rental or something like that, Schedule E, and so on and so forth. So home mortgage interest. If you are a homeowner who receive assistance under a state housing finance agency hardest hit fund program or an emergency homeowners loan program, you can go and see publication 530 for the amount you can deduct in that situation. A home mortgage is any loan that is secured by your main home or second home, regardless of how the loan is labeled. So obviously, when you're thinking about a loan, if you're going to purchase the home, then you're going to get a loan. Typically, it's a mortgage, right? And that basically means that the home is collateral on the loan. So if you default on the loan, then the bank has recourse possibly to then the home in order to help to pay off the loan in that situation. So that's generally the situation, and in that situation, then the rent or the interest on that particular loan may be something that that could be deductible on Schedule A. It includes first and second mortgages, home equity loans, and refinanced mortgages. So a home can be a house, condominium, cooperative, mobile home, boat, or similar property. So there's pretty wide definition of what a home is. In this case, you're living in it, so it could be a condominium, a mobile home, a boat, or something like that. It must provide basic living accommodations, including sleeping space, toilet, and cooking facilities. Limits on the mortgage interest. Your deduction for the home mortgage interest is subject to a number of limits. If one or more of the following limits applies, you can then go to publication 936 to figure your deduction. So typically, for most people, when you're having, like a purchase of a home and you have your home loan, the interest on it will typically be something that will be deductible, but there could be limitations on it, and there could be caps on it if you're have a high basic loan or something like that. So let's take a look at the limitations. Limit for loan proceeds not used to buy, build, or substantially improve your home. So that's going to be kind of the thought process of obviously why you would take the loan out. You would have it to buy or build or improve on the home typically. But note that if you can deduct the interest on the home loan, whereas you cannot deduct interest on like a car loan or interest loan, then you have an incentive to use the home as collateral to take money out, to take a loan, and then have it under the home loan so that you get a tax deduction on it. So the fact that the personal loans, you cannot deduct the interest on it, but if you were to be able to deduct home loan interest, it results in people wanting to refinance their debt that would be outside in other personal areas to the home loan, and they're going to basically try to restrict on that. So if you purchased a home and you took out a loan directly for the purchase of the home or for home improvement, then that's a pretty straightforward loan using the home as collateral. That would be a normal situation. But they're going to limit situations where you're going to say take out a loan to buy a car or something like that, but you took the loan and used the home as collateral for it to try to have the interest be deductible in that case. So those are kind of general idea of the situations where the limitations could apply in this case. So you can only deduct home mortgage interest to the extent that the loan proceeds from your home mortgage are used to buy, build, or substantially improve the home securing the loan. That's going to be qualifying debt, quote, qualifying debt, end quote. Make sure to check the box on line 8 if you had one or more home mortgages in 2020 with an outstanding balance and you don't use all the loan proceeds to buy, build, or substantially improve the home. So the general rule, buy, build, substantially improve the home. That's when the interest related to the loan would be deductible. The only exception to this limit is for loans taken out on or before October 13th, 1987. The loan proceeds for these loans are treated as having been used to buy, build, or substantially improve the home. See publication 936 for more information about loans taken out on or before October 13th, 1987. See publication 936 to figure your deduction if you must check the box on line 8. So limits on home mortgage interest. So now we're going to have limitations like a cap type of limit. For qualifying debt taken out on or before December 15, 2017, you can only deduct home mortgage interest on up to $1 million or $500,000 if you are married filing separately of that debt. And then we have the limit on loans taken out after December 15, 2017. So if the loan was after that point in time, for qualifying debt taken out after December 15th, 2017, you can only deduct home mortgage interest on up to $750,000, $375,000 if you are married filing separately of that debt. So you can read the rest of this on your own here, but that's going to be the general rule you're thinking about that basic cutoff date. So let's go over it one more time. For qualifying debt taken out on or before December 15th, 2017, so this is the debt was taken out before that time. Obviously, as of now, 2020, if you're filing the tax return in 2020, it has not yet been paid, but the debt was taken out before this date, December 15, 2017. You can only deduct home mortgage interest on up to $1 million or $500,000 if you are married filing separately of that debt. And then if we're talking about after that point in time, your qualifying debt taken out after December 15, 2017, you can only deduct home mortgage interest on up to $750,000 or $375,000 if you are married filing separately of that debt. Now, for most people, if you're an average home purchaser, then you should be okay with these limits. If you're working with higher income level people, then you can have problems with these limits. So we're talking about the loan because obviously most people when they purchase a home, the value of the home will not much exceed possibly 750,000, and part of the home you usually would want to put a down payment on it, and therefore the loan amount probably for most people isn't going to hit that threshold. But if you're talking to more well-off individuals, then it could well be the case that it does. And that's when you would run into those restrictions that you'd have to be aware of. Because remember, when you're looking at the 1098s that are going to be coming in, you're often just looking at the interest amount on it. And if you're looking at thresholds where the loan balance is over a certain amount, then you're going to have to take that into consideration. It might not be something that you would just see on the interest documentation for the 1098s that you receive. So if you know the loan is over the threshold, then you need to take that into consideration. It might not be something that will be simply documented to you on the 1098, because the 1098 that you will receive will typically, again, just have basically the interest that needs to be reported on it. So back to here, points not reported on Form 1098. So remember, again, the 1098 is going to be a form. A 1099, you're thinking in your head, when you get a 1099, you're thinking this might be something included in income. A 1098 is something that the IRS is basically requiring someone to report, usually financial institutions such as this. That could be something that you may be able to deduct. So now we got the Form 1098 reporting the interest that might be something that we can then deduct. So now we have points. Points are shown on your settlement statement. Points you paid only to borrow money are generally deductible over the life of the loan. You can see publication 936 to figure the amount you can deduct. Points paid for other purposes, such as a lender's service, aren't deductible. So there could be some confusion in terms of how they set up the situation with the home purchase and the loan and points related to it. And this will typically come into play in the year of purchase. So in the year of purchase, you're going to want to take a look at the settlement statement and the closing statement, and then consider whether or not there are points involved that might be something that could be deductible or depreciable or amortizable that are not included in Form 1098. So you want to look at the closing document, the closing statement typically related to the home purchase, and see if you could pick those up in the date or time that the purchase took place. In following years, it should be fairly straightforward if it was done properly in the year of purchase or the year the loan was taken out, and then in the following years it should be fairly straightforward if you're using the same tax software. Okay, so refinancing. Generally, you must deduct points you paid to refinance a mortgage over the life of the loan. So if you have to deduct it over the life of the loan, that means that basically you're going to have to amortize it in a similar fashion as with depreciation. So again, that's something that if done right, when the refinancing first takes place, then it's going to be fairly straightforward going forward if you're using the same tax software, because the amortization should roll forward. If you have a new client that had points that are being amortized over the life of the loan, then you got to make sure that you're setting up the new information in the software properly so that the amortization process, is correct going forward. This is true even if the new mortgage is secured by your main home. If you use part of the proceeds to improve your main home, you may be able to deduct part of the points related to the improvement in the year paid. You can see publication 936 for details there. Investment interest. So now we're moving from mortgage interest to investment interest. This is going to be interest related to investments. You can think of them kind of like a business expense, in that investments are used in order to generate revenue. If you had to take out a loan and pay interest in the attempt to generate revenue, then you would think that would be kind of an expense. It would be kind of like a business expense, because you needed the expense in order to have revenue generation, and therefore possibly deductible, as opposed to personal expenses, which aren't geared towards revenue generation and therefore normally are not deductible, with the home mortgage interest typically being the exception to the rule. So investment interest is interest paid on money you borrowed that is allocated to property held for investment. It doesn't include any interest allocable to passive activities or to securities that generate tax exempt income. And here's going to be an example of the 1098 that you might get. So you might get this from the institution. If someone has a loan for the home loan, then you'll typically get some format of 1098. It might not look exactly like this, but the boxes will once again line up. So if you have questions about it, then you can go to the IRS website, look up the instructions for the Form 1098 and have your questions answered there. We have the mortgage interest receiving from the payer borrower here in box 1.